Hey gang, so today I'm going to take you guys through what I do to analyze a real estate property and using our hold worksheet. So if you see a different tone in the content from now on, it's going to be a lot more of what I had questions about when I first got in and different things that ring true to my mind. And then I'm kind of just going to be answering my own questions. So for those of you that are out there that are into making money, then this will be for you. And then unfortunately, everyone else, this will be very boring. So it's not for you. So there you go. So we'll get right into it. So I know if you feel anything like me, I think that numbers are a lot sometimes. And when it comes to real estate, everybody keeps it there's so much jargon that goes on, and then you don't really know what's actually happening. So I'm kind of going to break down exactly the three main ways that you make money in real estate. So I have one of the properties that I have on the market now, and it's primarily investor focused because the client is an investor and he's been holding this thing for a while. So I'm going to give you guys kind of an insight on the returns that'll happen, like if you were to purchase a property or another, but really just the main things that I'm looking at when I see a property like this. So this actually turned out to be a pretty good deal, so you'll want to see it. So the first page here, so there's two pages of the hold sheet that are important. This first one is basically the analytical tool. So this one kind of gives us surface level numbers, let us know what did the deal look like, what was the purchase price, and what are the returns as far as like monthly cash flow and how much your taxes, things like that, like the upfront cost. And then the second one here kind of gives more of the nitty gritty breakdown of it. And so I'll explain it, and I promise it's not that overwhelming once you understand it. So it was listed for 110, fair market value right at 110. We went aggressive with it. And so we're going to take the scenario that it goes at full asking price, which means they purchased it for the full 110,000, and you put 20% down. So if you put 20% down, that's $22,000, meaning that you finance $88,000 at a 6.9% interest rate. So this is kind of like the finances portion. So you simply put, you purchased the house for 110,000, you put 20% down, which is 22,000, and then the rest of it is financed with the bank. So that bought your monthly mortgage payment, just the mortgage, to $579.57. So then there's other expenses that come with it too. So I'm going to skip this and go to the other expenses. So other expenses is I factored in for a property management company because you might not want to self-manage the property. So typically they charge anywhere from 7 to 10%. So we'll put 7% in, which is about right under $100 a month. Property taxes, $133 a month. And then insurance, we're running it at like $125 because it's a condo unit. So a lot of them have it factored into the HOA. So, and then specifically for this one, the HOA is $298. And now that I'm looking at this, we could probably go lower in the insurance. It might be less, but we'll leave it for the example purposes. But $298 on the HOA fees a month, which again, this is a condo, so you're going to see higher HOA fees in general. So those are all the expenses. So if you add those two up, you have, I actually don't have a thing for that. So let's just do a calculator. So 579, 57. Oh, that's not it. Okay, let's clear that. 579, 57 plus 65608. So your expenses, total expenses right now are right at $1,235 a month and 65 cents. And so that becomes like, those are your costs. So if you were to have no tenants or anything, this place is costing you $1,200 a month. So that's a very important number, just in case. You know, you always want to play for this just in case. Now, let's factor in what this place will rent for. So obviously in the back end, I've already ran rental comps, what it'll actually rent out for, and it'll rent for about $1,500 a month. Okay, so $1,500 a month. is coming into the property. So now what we always want to do is factor in for a vacancy rate, and that's simply because like there's going to be turnover time to new tenants, or if there's a portion. I'm sorry. Harlow, hush, please. So we factor in the vacancy rate just in case there's no tenants, or if you need to find new tenants, there's going to be like a dead period in there where you're probably going to have to pay some of the expenses. And that's also not including utilities, but in a condo unit, I mean, sure. But yeah, so after vacancy rate, you're looking at about income of $14.25 a month. So which is really good. So in the hindsight, you're cash flowing, and cash flow, all that means is what are you making after expenses is about $189.35. So this is important. So a lot of people like this portion of real estate, and this is probably the most popular one, just because like that goes into your pocket every month. Now you can do what you want with it, as obviously as you like, figure out what you want to do with the funds, but at the end of the day, that's your net total after expenses. So a positive cash flow in this market, especially here in Dallas, like is a good deal, because cash flow is king at the end of the day. So that's one portion of it. So there's three ways that you actually make money in real estate. So it's appreciation, which is basically when if you have a property, it naturally makes money over time just because supply and demand. So typically we account for about 4% year over year. So every year you get 4% of appreciation added on to your property value. So if you buy it at $100,000, then you can expect for it at the end of the year to be worth $104,000. And you do that every single year, and it just keeps compounding. And so so that's one way. The second way is cash flow. Obviously, you can pocket this $200 basically every month, and that's your income. And then the third way is a way that nobody really talks about, is paying down debt. So, and we'll get into this in the second page here in a second, but think about like there's still 88% that is getting there's 80% of this loan that belongs to the bank, and they're charging you 6.9% interest on it. So that's potential money that you are absolutely missing out on, and I'm gonna show you exactly how much in a second. So that's kind of the first page. That's how we break it down. If the deal is kind of like on the edge here and it's like not really making money, but it's like even, then I really take a look at the second page to see what the returns are in the next few years. So we're going to just take a look at the second page, and we're just going to look at the next 10 years. So year 1, year 2, year 3, 4, 5, 6, 7, all the way to 10. Okay. Now, and I think I zoomed in enough. Yep. Okay. So we're just going to look at the 10 years. So all of these numbers mean something, but for the purpose of this video, I want to stay focused on the three ways. So let's just take a look at appreciation. So if we stay with appreciation and you purchase this property for 110, like I said, you can account for 4% appreciation year over year. So here's after 10 years, this property is worth a little over $150,000, and you've done nothing with it. So that's one of the big ways that you make money in real estate, is just buy and hold. That's what they talk about. And honestly, that's why I always say the longer you can hold, the more money you make. Because just think, if you held this property for 30 years, you're talking $340,000. And so a return off of a $20,000 investment looks pretty good. So that's obviously a huge way that people just forget that you make money in real estate. The only problem is it is not liquid. And when I say liquid, I mean that the cash is not accessible easily. Like if I put money into a bank account, I can pull it, and it's a liquid asset, because cash I can use it immediately. But real estate is not that liquid, because it takes a process to sell it. And then it's a matter of, will it sell, or when will it sell? And it just takes a lot more to be able to access the cash. So you just want to be able to That's why people overlook it, is because it's not as liquid. That's why cash flow is so appealing to people, because you just get the money. So yeah. So this is the property value. And then this is like, if you want to look at individual money, how much you actually make each year. So $4,000, $8,000, $13,000, $18,000, you know, every single year it keeps going up. And so you make $50,000 just holding this condo. Okay. So that's a very important part. So that's one way to make money. Second way is going to be the debt pay down option. Okay. So remember I was talking about that $88,000 or the 80% of the loan that the bank is like charging you for, that interest rate. So look at this. So this is your loan cost. So this is how much the bank, you owe the bank. Okay, so this is how much money you actually are missing out on by not having full ownership in the property. Now, on the bright side, because appreciation happens and because you continue to pay down your loan with the mortgage payment, this goes up. So your equity is how much that you actually own of the home. So if you were to sell the house today, you would only be able to take out the equity of the home, and you have to give the rest of the proceeds back to the bank. So the goal is to lower this number and raise this number as fast as possible. Okay? So the higher this equity number goes, the more money you'll make when you sell it. And it also takes down your expenses. So if we go back to the first one, this mortgage, $500, $600 almost, goes away completely if I say we paid full cash for it. You see that? And then look what it does to our monthly cash flow. So now instead of cash flowing $180, you cash flow $768, which is very important. And that is $600 that is, or $500 that can go into your pocket every month. So that's why they say paying cash or as much possible in this specific example is very appealing for cash flow purposes. Okay. And we'll talk some other strategies because there's different ways, but I don't want to confuse. So we'll just stay focused on this. Yeah. So, let me put it back on 20% so we can see the gains if you were to just put 20% again, because I'm talking to the everyday average investor, because this is exactly how I was thinking when I got into it. So just bear with me. Okay. So important thing to remember. So appreciation is one. So this happens naturally. Now, in most areas, especially here in Dallas, appreciation happens a lot faster. So the percentage goes higher. So you'll see higher returns a lot of the times, and we can kind of play with it here. But a lot of the times in Dallas, over the last 5 years, we're averaging 10%. So instead of 4% appreciation, we're averaging 10%, and then look at this return. So after 10 years, you're at $250,000. And then look at that 30-year mark. It's a $1.7 million condo. Obviously, that's best case scenario if it appreciates at 10% every year. But I'm just saying, just look at the potentials depending on your area. So if you're in Colorado or in Louisiana or things like that, you have to look at what your specific appreciation rate is, and then you can factor it into this. But national average is 4% each year. So we'll just stay with that. Okay, so debt pay down, appreciation, we're taking care of that. We're making money this way just by holding it. We're making money here by paying down the equity, paying down the debt and paying off the mortgage. Okay, so the more and more we own, the more and more we can sell it for, the more and more money we'll make in the back end. And it also helps with our monthly cash flow. Because later on you can do what we call a refinance, but I'll get into that strategy later, like I said, and then you'll see the best way to use your cash. Okay, so the last way to make money, well, there's plenty of other ways, but for the purposes of this video, the other way to make money is the actual cash flow. So this is very, 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 very important. Okay, so a year, remember, we're talking $189 a month. Okay, wait, this is not right. This is not right. This is the accumulated cash flow. Okay. I'm sorry. So we'll highlight this green. Okay, so take a look at the S column for me. Okay, so this is your accumulated cash flow. So this is how much money you've gotten from the tenants year over year. So this accumulated cash flow is how much money you've made year over year, month to month from your tenants. So the first year, you're only looking at about $2,200 a month, but like that's an extra $2,200 a year that not a month, a year that you're looking at that you didn't have in the previous time. But just the important part is look how this compounds. So 2,200, 5,000, 8,000, 12,000, and after 10 years, you're making 46 grand a month on this property. Now, keep in mind from the debt pay down option, this was at making $189 a month and only 20% down. So, by that calculation, you make your money back just in cash flow after, was that 6 years. So if you hold this property and you continue to make money over 6 years, you have paid for your investment. And that's just in cash flow, not even counting the appreciation, not counting the equity. Okay? So just in cash flow, $20,000 after 6 years, almost $50,000 after 10 years. It's very important. So after all, the important part is, yes, that is one primary way and very liquid way of making money in real estate. But the big return is the fact that you can make all three of those at the same time. Okay? So let's go over here to the blue section where we look at the total ROI, which stands for return on investment. Okay? So your accumulated cash in this property after the first year, you end up losing some money. That's okay. That is okay. After everything, you end up losing about 1.9%, 2%. Okay? But look how this bad boy jumps. Look at the second year. 34% return on your money. Tell me anywhere else where you can get a 34% return on your money in 2 years. Besides business or Bitcoin craziness or anything like that. Okay? There's not many stock options or safe options like this. Okay? This is very, very important, and this is why you see the majority of millionaires invest in real estate so early. Okay? So this is very, 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 very important. Okay? So 34% after the second year, 73. Look at that. Year 4, you have completely made your money back. You have 117 return on your investment, your initial investment. And keep in mind, this is after cost of sale. So this is after you sell the house. This is saying that you sell the house and then you get the money. You've recouped your money. You've recouped all of the money and made 17% on top of that. Okay? But if you continue holding it, let's keep the 10-year basis. Look at that. 5x return. Almost 5x, 4.5% return. 4.5x return. 450%. Okay? After 10 years, all you did was buy a condo and lease it. That's it. You spent $20,000 and you have made $100,000 just by doing nothing. And again, that is not accounting for if you paid off the debt faster or anything like that, raised rents, things like that. That's not accounting for any of that. Okay? So this sheet solely changed how I look at investing and what different returns look like in different channels. So if you look at S&P 500, on average, it makes about 9% year over year. Okay? So like 9%, 18% after year 2, 27%, 36%, 45%, 56%. Like, you know, that's that, or 54%. That's pretty much where you're getting. In that same amount of time, you have 2x your money in real estate with this specific condo deal. It's not to say that there's way better deals out there. That's all I'm saying. So if you're anything like me, you will look at this and be like, and have a serious aha moment and understanding on why your money is not, why you're not getting the returns that you see on like all the socials and things like that. So this is the fastest way to get to that million mark, and definitely is a surefire way to get crazy returns on your money. So if this is something that you like or don't like, let me know below. And then I can kind of dive into some different properties, different deals. But I kind of want to take this more of a strategic route and target the people like me that are simply just interested in making money, and hopefully provide enough value there to where you can do it for yourself. So let me know how you feel about this. And then, like I said, just all I ask is that you share it with one friend, you share it with somebody that you think would be interested. And then, but nonetheless, I'll see you guys in the next one. I appreciate it.